Hi there, welcome back to Macro Mentors podcast. We're here with another one of our mentors, Gabriel. Gabriel assists many alternative asset managers or alternative investors and investing firms. And we thought it'd be interesting to have him here today to talk a little bit about what he does and some of the trends that he sees in the industry. Gabriel, would you like to do just a brief intro of who you are, kind of what you're doing with Waverly Oaks?
Sure, absolutely. Thank you, George, and thank you, Armin, for inviting me today. So I've spent just shy of 3 decades in finance, more specifically in the investment side of the business. I started life as an equity research analyst, eventually moved into new business development. I've worked for small, medium, and large asset management firms across the globe. And for the last few years, I've been focusing on consulting. I launched my own business called Waverly Oaks Advisors. And what we do is primarily work with 2 types of managers. A is pure startup or emerging type of managers. And B is managers that maybe have raised their first billion and hit a wall and understand why they hit that wall. And that's kind of where we come in and assist both emerging managers and large managers. So really helping folks understand their business, institutionalize their business, potentially launch new products, give them guidance on fees, structure, organization, compliance, etc.
It's very interesting. Before we dive into this trend, sorry, George, how did you kind of make this decision to start up your own shop?
Yeah, so if I look at the progression of my career, I started off at very large asset managers and then slowly moved to medium and then eventually ended up at smaller managers. And I have to say I liked all my experiences, but really sort of rolling up your sleeves as my sleeves are rolled up right now.
Right.
Launching a new fund is kind of fun.
Yeah.
And very interesting and potentially rewarding. So I didn't want to be employee number 523 at a 500 billion plus asset management firm. I really wanted to kind of make a real impact, and I think you can make a bigger impact with the smaller players and the smaller medium-sized players in the business, and that's the primary reason why I decided to go down this road.
Great.
Yeah, I can kind of speak from the hedge fund side. There's definitely a flywheel effect. Once you get to a certain AUM, more investors can look at you. I think people will be quite surprised how fickle it is from the outside. Certain people don't want to be certain sizes of the fund or like a certain proportion of the fund. Certain investors will come in if certain other type of investors come in. And I think you are right. You get to a certain AUM and then you almost need one person to take a chance on you to some degree to propel you into the next chunk where maybe a state pension fund will start investing. And then once you've got one, you get 10 and you kind of move up in steps. Looking at the specifically, what do you see as the kind of evolving trends in the alternative space broadly?
Sure. So let me highlight maybe a couple. The first is really from the allocator standpoint. And what's happening there is allocators are redefining how they bucket alternatives. And this trend really started with the early adopters 10, 12-ish years ago. And now it's being picked up by the followers in the industry. And let me explain that for a little bit. If you turn back the clock 20 years ago, what allocators did was they the advent of, or I say mainstreaming of venture capital, private equity, hedge funds, so on and so forth, a new bucket was created. And that bucket was called alternatives. But what, I guess over time, allocators are asking themselves, what does that mean? What does that mean exactly? So they really started performing some research and trying to understand, maybe we're just bucketing alternatives incorrectly. We need to understand what the sources of return are. So if you look at venture capital or private equity, just to pick those two up for this conversation, the sources of return are equity or equity-like type of returns. It's obviously, maybe S&P plus something or NASDAQ plus something, but effectively the returns are driven by some sort of equity or equity-like component. So you started seeing allocators change their strategy in terms of bucketing alternatives to, okay, I'm going to take out my VC and private equity allocations from this alternative bucket, move into my equity bucket. Maybe I'll dial up my equity bucket, but now it includes pure public equities, private equities, venture capital equities, and it probably now includes long short equities or anything else that is equity like. And they sort of, on top of that, they sort of changed the name of this alternative bucket to maybe call it absolute return, and they put pure absolute return managers in there. And what's an absolute return manager? Again, I'm not just to pick out a couple. It could be a global macro fund. It could be a CTA or commodity trend following type of fund. Funds that really can't point their finger to a certain type of other risk, whether it be equity risk or credit risk, that helps drive their return. So fast forward to today, what you're seeing now is a lot more of the, again, what I call the follower institutions or follower allocators, the smaller and medium-sized allocators, take that new bucketization on in today's world. And you're also seeing that in the private debt world, where the private debt managers or the private credit managers used to have a special bucket. Now it's been moved into a fixed income bucket because effectively it is another flavor of fixed income. So that's the first thing I would say. The second I would say is maybe a little more recent, and that's related to where allocations have gone. And if we look at 2022 and the start of 2023, now we're 2+ months into it, I think you can say in regards to alternatives, it has generally slowed down across the board. And why is that? I mean, there's a variety of reasons. Like if you look at crypto, interest there has fallen off the cliff. Obviously, crypto's off by 2/3 from their highs. When you look at, again, highlighting venture capital and private equities, equity markets have really slowed down in 2022, and in 2023, they're sort of bouncing around. We still don't have a trend in either direction here. But that has made it very difficult for venture capital funds and private equity funds to have exits. And if you can't have an exit and give an allocator their capital back, allocators can't source new funds. They can't allocate to venture capital fund number 9 or number 10 or number 11 in the era. So there's this issue of, well, either my pie has to grow, and that's not happening because risk assets have not increased, or I need to get capital in. And one source of capital coming back is obviously from exits. So IPO market is pretty quiet. We've had a few large IPOs here in 2023. We've actually got one coming up on, I think, Thursday or Friday. That's a $500 million IPO. So I'm kind of interested to see how that goes. But I think we can count the 200 million plus type of IPO this year on one hand. It's been very, very dry. And that's true of secondaries as well, which is another exit mechanism for private equity funds and venture capital funds. It's been slow. Better than the initial public offering market, but follow-on offerings are definitely not at what the pace was in 2020 or 2021. So I think those are some of the trends that we're experiencing in the market.
And what do you think, like, which are the buckets then that might be kind of, might be short on interest, let's say over the next months or right now that you're seeing?
Yeah, that's a great question. And I would say the strategies that are bucking the trend are energy funds. We've had a big run up in commodities, and there's been some trends there. Multi-strategy funds, the likes of, the Millenniums, the Citadels, the Brown Howards of the world, and global macro funds. Those are sort of the three fund categories that come to the top of my list, and as in regards to near-term interest or higher interest from allocators.
Okay. Interesting.
How do you think about the demand for, let's say, private investments versus public? One of the trends that we've obviously seen over the last decade is a greater share of the pie has been going to the private side. I obviously, from a public side, point at all the flaws of the private side, and the private side obviously point at all the flaws of the public side, pointing at us. How do you think about that balance? What's the demand like on a relative basis? It feels like to me that investors actually, in a slightly lower liquidity environment, actually are starting to prefer the public side over privates, but I don't know if that's kind of what you see on your side.
Yeah,
No, they understand it's not. Sorry. Yep. No, George was just saying, like, it's not real until it's realized. I think, like, there was the joke last year. So
yeah, I would say near term, I agree with you. Liquidity is certainly king. Cash is king. We've seen, look, you can buy a 3 or 6 month US Treasury bill and get paid 5%. Cash is king. So I think allocations near term have definitely changed to liquidity. We've seen some interest in long only fixed income. So there's definitely some interest there. I would say in terms of maybe a longer term trend in privates is the general increase in interest in private credit, private debt. And when I talk about private credit, private debt, that encompasses a very broad spectrum. That could be direct lending, mezzanine, specialty finance, real asset credit, even venture debt. Venture debt has gotten pretty popular. And I think this is experiencing a secular bull market. 5 years ago, there was about 250 private debt type of funds of size, not talking about the super small ones, $10, $15 million, but of size. And that number has grown to double as of last year. Assets 5 years ago in the space was only about 600 billion, which is, a big chunk. Last year, it was more than double. And by 2030, many forecasters are predicting assets into private debt, private credit, it's going to jump to 3 trillion. So,
wow.
It's an area that I think is on a secular bull market. And, there's a variety of reasons we're seeing this. It's, relative to venture capital, private equity, it's a much more liquid space. These funds tend to have shorter lifespans. They pay out a coupon or yield. So there's some carry to pick up. And it's easily understood. So I think there's a lot of interest in that space. And as we've seen banks pull back, these private credit or private debt funds have really kind of stepped in and taken a place of banks in terms of providing financing for a variety of transactions.
And looking at the bucket of, PE or especially VC, do people really kind of see it as as just one? Like a homogeneous kind of bucket? Or obviously everyone right now wants to get their hands on, or all of the VCs want to get their hands on ChatGPT and all related kind of AI applications. And so is there any other trends that you see in that, not in the AI space, but any other kind of kind of parts in this bucket that kind of that are interesting?
Yeah, I think so. I think there's probably, in addition to AI in general, there's definitely interest in the VC world relative to new energy or climate technology. So yeah, we're seeing significant interest in anything that has to do with technology related to climate. So but unfortunately, it doesn't come quite to my head at the moment, but there's been some very interesting transactions in that space. So yeah, I think that's still a big trend. I think in the private equity world, there's a lot of dry powder. A lot of these private equity funds
Right.
are still sitting on big chunks of capital, and we've seen big players like Vista or Thoma Bravo has been very active in buying technology companies that have pulled back significantly in 2022 and 2023. And, so I think there's still going to be flow. There's still going to be transactions in that space.
I think in Europe, one of obviously the big one is more the renewables infrastructure seems to be where the PE money seems to be flowing, from what I understand. We're suddenly looking at having to build electrification all over Europe. Suddenly, thanks to Mr. Putin, quite a few LNG terminals need to be built. And it seems that PE has really stepped in to fill that infrastructure role. And from the kind of private market documents I've seen, I know you've talked about this concept that PE and VC are kind of equity-like returns. I think infrastructure seems to be carving out its own kind of slot in the asset allocation pie next to, I guess, real estate, where maybe they get a little bit of their own share. And I think the government desire for infrastructure growth is pretty punchy, and that's kind of feeds down through these pension funds that you'd rather have kind of Uncle Sam on your side than be fighting him, I guess, at an aggregate.
Yeah, no, you're absolutely right. Absolutely correct.
How do you think the environment has changed? Let's say Armin and I were new founders of a fund in the last couple of years, or just in the industry in general, for us being able to launch. Has any of the regulation changed? Are investors looking for certain different traits? Obviously, we understand that there's thematic buckets that are more interesting, like climate. But at like a board level, business level, is there anything that kind of stands out?
Yeah, I would say, look, as a very sort of 40,000 foot level statement,
Sure.
It's always very challenging to raise money. It's a very big business. There are lots of asset managers, and I know many allocators, and allocators are just inundated with phone calls. So I would say, again, as a 40,000 foot level statement, it's very challenging to raise money. Diving a little deeper into that, I think, as a new manager, it's even more challenging for a variety of reasons. So, obviously bigger managers have now fees coming in, they have deeper pockets. But as you sort of quickly mentioned, the compliance environment just gets worse and worse every year. And worse is probably the incorrect term to use, but just gets more challenging.
Expensive.
Because I think obviously compliance is a good thing in many areas. We do need regulation to some extent. But, if you look at just 2022, for example, the SEC has been very active. They have proposed over 20 new regulations, which has far outpaced new regulation proposals from 2021 in prior years. They've highlighted numerous items that need to be on the top of investment managers' lists. Cybersecurity being one of them. Communication devices, and we've actually seen some of the big broker dealers take big fines for having communications with clients on private messaging services. And interestingly, you may have read that some of these broker dealers have actually passed those fines on to the employees for the employees to pay in terms of cutting back their bonuses. So, you're seeing this compliance regime just get more complicated. And whenever things get complicated, they get more expensive. And what does that mean for a new manager? Obviously, your break-evens just keep going up and up and up. And if your break-even 10 years ago was maybe $200 million or $100 million of assets under management, those numbers are now more like $300-400 million. So, that's certainly very, very challenging. More specifically to fundraising, as I said, it's always challenging to raise money. I think as a new manager in the hedge fund space, we talk a lot about VC and PE. Let's just turn our attention to hedge funds. I think it's even more challenging. Generally speaking, the run-of-the-mill hedge fund strategy has not been favorable, hasn't done well over the last several years. If you turn back the clock 5, 6, 10 years ago, pick up your favorite alternative investment news trade rag or news publication, and it was very common to see, so-and-so launched with $500 million, or XYZ spun out of Millennium or Citadel, whatever, pick your big firm, launched a $1 billion hedge fund. You really don't see that anymore. I mean, I was kind of thinking about this before we jumped on this call. I was like, when was the last time I've heard of $1 billion plus one?
What are success stories?
And, I had to go back to, I think it was 2017 to 2018 when D1 launched. The ex-CIO from Viking, and Sundrum. And that's a long time ago. I mean, I don't know. Can you guys think of a hedge fund launch? Even greater than $500 million over the last few years. It's a head scratcher.
There's been a couple. There's one in credit called Avini, which has been quite a very successful trader who came from Credit Suisse. Pinbrook, I know the guys from there. They've managed to get set up. But yeah, you are 100% right. It's a much, much more difficult environment. I think also the multi-strat manager deal has got better for both the multi-strat manager and the employee, where they've managed to do the pass-through costs. So the investors are wearing more of the risk in terms of costs. And for just the guy who is guy or girl, sorry, who's the talented trader or investor, they can basically turn up and get plugged in, do their job, and then go home. They don't have to necessarily do fundraising. And that's always the kind of tricky part is I'm very successful at one thing. That doesn't necessarily mean I'm very good at storytelling or entertaining investors. And I know that Russell Clark, who's one of our mentors, talks a lot about this, about how bearish stories are better for asset raising and bulls make more money. And he said it's a real kind of irony of the business. And he said you really need to have a good story to tell, or a variant perception to everyone else, irrespective of maybe the return profile not being quite as high as someone who just say, I buy stuff when it goes up and I'm good at it. As a kind of one of the questions that Armin and I were talking about before this is, imagine we are rockstar investors and we came to you and we said, we would like for you to help us set up a fund vehicle. What does the actual process of that look like?
Maybe if you guide us through with also like other challenges apart from the legal costs.
Yeah, no, it's another great question. I would say the following. I think the first thing you would need to do is sit down and have some reflection. And, this, as you said, the challenge is, do I just go to a multi-strat shop, do what I do best, which is manage money, and forget about legal compliance, entertainment, hiring and firing people, so on and so forth. So I think the mindset is, you've got to get your mindset squared away. Okay, I'm going to do this. I have to dive in 200%. My family has to be on board. I need to have enough money in the bank. And obviously, the time and energy. So, I think once you've sort of had that conversation with yourself, the next thing to do is, speak to other fund managers. Speak to your former colleagues in the business or old friends that maybe have launched funds. And don't only talk to the success stories, speak to folks that were not successful. I think the third thing to do is then sit down and write a business plan. And what I find is most investment managers don't write business plans. Honestly, they don't sit down You write a business plan. Okay, I'm an investment manager. I want to launch a fund. This is what I want to do. And go ahead with your plan. Your plan should include lots of items. The money you're going to put in, what your break even is, your org chart, so on and so forth. I mean, it's got to be multiple pages of information. Then the next step I would say is go have some casual conversations with, again, former colleagues, friends, investors, and figure out if there's a demand for what you're thinking about offering. And after that, I think you can then have another sit down with yourself and be like, okay, is this a go or a no-go? Do I have enough investors lined up to make this a real business? And do I think I have a pipeline going past that? And if you think your answer is yes, I would start going to the next step and start talking to service providers. I think the first one to call is probably your prime broker or prime brokers. Talk to them, get an assessment for them in terms of demand for your strategy. I then slowly start talking to other service providers. You're going to have to hire an auditor, a legal advisor to help write legal documents, your placement memorandum, your limited partnership documents, so on and so forth. And then, following that is start identifying talents, build your org. And then following that, I would say you've got lots of things to do that should be done concurrently. And that is, start drafting your legal documents with your legal team, put a presentation together, other marketing collateral materials, build a website, and then go out and market. Go pitch.
And from the first sit down that you mentioned, obviously might be hard to say, what timeline are we talking? Let's say if I think about it in my first sit down, what kind of timeline should I have in my head? Obviously it will vary probably, but is there anything like that?
Yeah, from there till actually launch?
Right.
The question?
Yes.
Actually, that is well over a year. Lining up all your service providers, hiring teams, if you want to build your org chart and hire high quality talent, that's going to take you some time. People might have to provide at a minimum 1 month's notice, if not 3 months notice, in some cases 6 months notice. So I would say this is easily over a year. And a part of that process, be prepared to write lots of checks with no income coming in. You're going to be writing lots of checks, paying a lot of expenses with zero fees coming in until you actually launch.
From your perspective, having seen obviously a few people do this, what do you think the common mistakes are that people make? I feel like, let's say someone's watching and they say, do you know what? I've done 7 of those 10 steps. If there's one thing that tends to catch people out or they underestimate, what do you think it is?
Can I pick more than one?
Yeah, of course. Yeah, give us a list.
I would say I'd probably pick on 3. One is identifying and securing a core investor. And a core investor is someone that's going to write a meaningful check that will help you attract additional capital. The second is sort of related but unrelated, is institutional level or high level deep dive due diligence. You'd be surprised that the number of managers that believe all they need to do is think of a name, put a shingle out, here I am world, give me money. It's going to take multiple meetings to actually get money in the door. I kid you not, I've spoken to allocators where after 1 or 2 meetings, the fund manager actually asks them, so when are you going to invest? And the process is much longer than that. I would say at a minimum, it is 3 months, and that is a very low probability. More likely, it's 6 months to 9 months of real due diligence. And real due diligence is multiple meetings of both the front office, excuse me, front office being the investment professionals, the folks that are actually putting the money to work, making investment decisions, as well as the middle and back office, operational due diligence, which is very important. And that's easily at least 2 meetings. So I think that's another important step. And I'd say the third is hiring high quality talent. Not only are you managing money, but now you're in the business of managing people. And if you're, let's just say, a small to mid-sized manager, you're going to have a team of minimum of, what's called 5 to 15 people. You've got to manage them. Everything from vacation time to their personal issues. Somebody might be going through a divorce. I mean, the list just goes on and on. So, this sort of comes back to the conversation you mentioned earlier about the multi-strats. Yeah, I think the multi-strats provide a great place if you don't want to deal with all this other stuff. If you don't want to deal with the people issues and compliance and the marketing and yada, yada, yada. Yeah, I think working at a multi-strat is a very good spot. And, unless you can really attract a few $100 million to start, it's probably not worth launching a fund.
Yeah, I think I would tend to agree that from what I have seen. I think one of the challenges that you see is often when the opportunity set is best and someone launches the fund, it takes them so long to raise the capital needed that the opportunity set often isn't quite as good by the time the actual capital comes in. I have some friends who are involved in a shipping fund that's been going, I want to say 5 years. And at some point in the last 5 years, shipping has been like a phenomenal trade. And kind of the ex ante with the performance is now coming the AUM. And so what ends up happening is you probably end up with a little bit of style drift in order to try and keep your AUM, because your original market isn't quite as hot. And obviously part of the game of raising money is kind of convincing people that your market's kind of hot all the time, which is a tricky.
Yeah.
I see it a lot I work within the volatility space. Last year we had a pretty decent macro vol year, emanating mainly from kind of interest rates and FX, and the money that's been raised in kind of, I would say, with the marketing slogan of kind of inflation, but volatility asset raising has gone through the roof in the last year, and that doesn't always now make the most fertile time to be long volatility, much as everyone within that space kind of wants to believe it at an aggregate level. The more players you have, the less information asymmetry that you have in the market. One of the things you kind of very briefly mentioned was the crypto space. Obviously, it's kind of feast or famine, I guess, a little bit is the crypto world. Are you seeing, I guess we've seen prices base out a little bit for the last, I want to say 3 to 4 months. Have you seen any renewed interest in that, or there's still kind of quite material battle scars from, I guess, what was really a kind of crypto credit blow up of the last couple of years?
Well, the money is trapped in the illiquid buckets, no? Isn't that the...
Yeah, exactly. Let me divide that conversation or my answer into two. Let's say the retail or high net worth investor and then the institutional investor. I think the institutional investor interest level completely gone. There's no interest there whatsoever. I think when it comes to the retail or high net worth, private wealth interest level, I think that has dropped off, but I think there is some interest there. Don't think people are as gung-ho as they were in 2019 or 2020, certainly not 2021. But, certainly there's been some price appreciation over the last few months. Clearly there's been some money coming into the space. But from what I hear and from people I talk to, that is primarily non-institutional capital. And I think, one of the reasons institutions still are struggling with this is, there's still some questions about safety and custody. And going back to our conversation, we were talking about regulation and compliance. I think regulation and compliance can be a positive, and certainly for that industry that I think needs some comfort and a level of comfort. Compliance and regulation, I think, would do wonders for the crypto industry.
Interesting.
Yeah, I think you it's quite interesting. I've chatted to a number of. I used to do quite a lot of the DeFi trading in crypto, and I used to be able to get 40% on dollars lending to exchanges. And one of the things that I think I underestimated was that as institutional money came in, they were fully funded accounts, which is quite a difference to like a normal hedge fund. So the platform guys who actually came in with dollars actually came in with real dollars. And actually, I think a lot of the blow up was related to the fact that these guys almost flooded the whole market with dollars and they needed to go somewhere. And that, in many ways, a little bit like '08, pushed lots and lots of the lenders who were guaranteeing people yields miles out on the risk curve. And the collateral chains that then like kind of unwound as one person went bad were kind of stratospherically bad. I think one thing I tend to see is you have kind of, I guess, like almost like three types of traders. You have the guys who approach it, I guess, with more like a financial markets background, I guess, which would be, I guess, me in the camp, where I tend to think of them as kind of digital liquidity assets. They kind of go up and down with the liquidity cycle, but they have a kind of embedded optionality to them. I think you then get the VC investor in crypto, and the VC investor in crypto kind of looks like a genius in the bull market because the returns are so spectacular. I think the part that the VC investor struggles with is they will see maybe adoption up, price down, and assume that price is then going to catch up to adoption. And what we've actually seen is that has gone kind of horribly wrong for a lot of these guys. I know a lot of people were really calling for things like Ethereum to really, really move. I think from the financial perspective, you could already see using data like cross-border capital data that liquidity was being pulled out of the system pretty aggressively from kind of the first quarter of 2021. And that really was going to make kind of the environment quite challenging. And when I look at kind of how money has flowed into that kind of, let's say, crypto management space, a lot of those people have ended up on kind of either side of that bucket, where they didn't have the money in the VC guys, so they didn't make the stratospheric returns, and they felt like completely left out. And like, why are you only up, I don't know, 100% when the VC guy's up 1,000? And then on the way down, it's kind of been a little bit of the opposite. And I think I watched quite an interesting interview with Mike Novogratz, where he said, like the first 60% down in crypto was actually like relatively easy to call. It was the final 20 that really got you. He was like, as financial guys, we were pretty hedged. The VC guys at this point have obviously blown out. And I think for like an allocator, that's quite hard to understand. Like what's the right asset mix of people to invest in? From what I see and hear, the high net worth guys know that they can be a bit more patient and don't think so much about the market. And so they're more happy to participate in owning some of the assets because they have this option like upside structure when they go well. You need one out.
Like the developers. HODL, right?
Yeah. Let's have a look. If you said, one of the things that people tend to have to overcome in a trading environment is ego. That tends to be the number one thing that holds you back. Would you say that that's the same? Well, I guess that applies to actually a lot of industries. Would you say that that's the same as what you see for the people who are trying to asset raise? It's an ego, or it's an underestimating of the task at hand? What would you say is like the common weakness that people need to work on, or that you see kind of repeated over and over again?
Before they start the process, probably as well.
Yeah. No, I think underestimating the task at hand is probably rises to the top. As I quickly mentioned earlier, the CIO or the senior partner often believes, hey, I've been an investor for 15 years. Here's my return stream, even if the return stream is just okay. Doesn't matter. I have 15 years of experience. I should be able to raise capital very easily. And that's not always the case. Performance certainly matters. Performance is one of the items that an allocator needs to check off. But, there's all these other items that need to be checked off as well. That's why they perform due diligence. The allocators have an investment committee to report to, or a board of trustees, depending on their structure, and they just can't write a check. So I think, certainly underestimating the task at hand is at the top of the list. Maybe a second one is not fully understanding how allocators think. Allocators don't have endless dollars to put to work. There's a finite amount of capital. Most allocators have a bucketing system. And if you're a fund manager, you need to fit into one of these buckets. And if a bucket's completely full, it's very challenging, unless a manager's on, red flagged or black flagged, whatever the system an allocator uses. It's very hard to kick a manager out and replace them with a new manager. There has to be something there that makes the allocator kick out a current manager and put in a new manager. And like I said, I think some of these fund managers that launch just underestimate that whole process.
Interesting.
Yeah, I think obviously in the hedge fund world, Citadel is one of the biggest funds, making the highest return also makes life hard, right? Because it's a lot easier to invest in the really, really big guy who's got all the infrastructure, and it's a lot easier political sell within an investment committee than it is to take the money and invest in the little guy who's a little bit unproven. And I think you would hope...
Exactly correct.
Yeah, you'd hope that the unproven guy maybe has a higher performance because he's able to move the assets around more. But it seems like the multi-strats are doing a phenomenal job at generating pretty consistent P&L. I think it will be interesting to see how certain areas of that multi-strat model operate with a higher financing cost. I do think that there's probably some changes in the pipeline. I don't think it will affect the kind of levered tactical books, but I think when you think about people who did maybe relative value or slightly more cash intensive books, I think they're going to be much, much harder to run with the current interest rates. Gabriel, we won't take up any more of your time. If people want to find out a little bit more about Waverly Oaks, or about you specifically, is there a website they can go to? Is there anywhere they can follow you?
Yes, no, absolutely. I have a website. It's www.waverlyoaksadvisors.com. I'll repeat that one more time. Waverly Oaks Advisors, plural.com.
Okay, awesome.
And obviously on Macromentus.
Yes.
Okay. Well, thank you very much for your time. It was super interesting. I think everyone gets to see finance from a different perspective, but it seems like you get a slightly more umbrella view than other people. And we really appreciate it.
Yeah, no,
thank you.
Aaron, George, thank you very much for your time, and thanks for having me. I enjoyed it very much.
Bye.